Welcome to DRJLT Economics. Today I want to discuss the inflation situation and the dilemma that the Federal Reserve is facing. I will divide today's podcast into three sections. In the first section, I want to just dissect the current difficulties in the dollar-based international financial system. And then I want to just dissect the dilemma that the Federal Reserve is facing. And then thirdly, I want to provide some of my own views on what is possibly going to happen. So first things first, and again, very concisely, I see that the dollar-led international financial system faces four major challenges, actually three, one of them being the inherent issue with the dollar, so let's say three or four. Right? Number one is inflation, which has reached a level that should be considered high and is likely to continue to go higher thanks to the decades-plus quantitative easing programs, which is just a fancy way of talking about monetary debasement, money printing. The same stuff that's happened for thousands of years. But of course, some very beautiful American scholar, I guess from Princeton, came up with a fancier word to describe the same thing. Now, it had surprised me that inflation had not set in previously, but for whatever the reason it is, the waves of inflation had started, and once it had started, the fact that a lot of money had been created in the last decade plus means that these money currently flowing in all sorts of bubbles will likely at some point come into circulation in the real economy and then inflate prices outside these virtual economies, outside financial assets, outside the investment realm, or like bonds, or real estate, stocks, cryptocurrencies, etc. And also vintage cars, baseball cards, and whatever. So that's the first problem. The second problem is, of course, high debt. High debt, not just national debt. The United States has very high debt, but that United States is not alone in this in having this problem, right? But also there's a lot of private debt. A lot of companies have used this period of loose monetary policy to increase their leverage. They borrowed a lot of money, sometimes for production, sometimes for vanity projects, and a lot of times for actually speculation in the stock market in the form of stock buybacks. Obviously, in my personal opinion, this should never have been legal, right? It is simply a form of, I would say it should be considered financial fraud, right? For basically the high management, top management of a company, of a public company, to borrow money in the name of the company and then buy back the stocks only to pump up the price of the stocks and then thereby get their bonuses. This should be a form of financial crime, but it is not in a lot of the countries, and it is in fact encouraged by investors and shareholders. So obviously there's a high debt situation, and thirdly there's asset bubble. I'm not going to talk about this to expand on this. anyone can see it. And lastly, we have particularly for the US dollar, it is in a uniquely advantageous position because it's a global reserve currency. And part of the reason that the United States had been able to do quantitative easing consistently for over a decade without seeing very high inflation is thanks to the fact that they are able to export their inflation to the rest of the world. But a problem that the United States will be facing is when the money that's been circulating in the rest of the world comes back to the United States because the situation changes. For example, let's say in other parts of the world there's a bigger financial crisis, higher inflation. What are they going to do? They're going to go put the money back into the United States. That's going to further drive up inflation in the United States, and that can be another source of trouble. And also, if at some point the US dollar loses its global reserve currency status, what's going to happen is, of course, again, this money is going to come back to the United States and worsen all the situations, inflation, debt, and bubble situations in the United States, making recovery more difficult and making stagnation more likely. So this is the first part of the podcast. I don't think anyone who has been paying attention should be really surprised by anything that I just said. So for the second part, I want to talk about the dilemma that the Federal Reserve is facing. I think, again, this is not very, I think, again, it should be something that everyone who has been paying attention should have thought of. But I'm just here to give my take on this with regards to the four major issues. So now we see, of course, the Federal Reserve is considering interest rate hikes in 2022. In the beginning of the year, I think there were talks about 3 interest hikes, each around 25 basis points. And then I think that a week after, it became four hikes. And then I think more recently, they have been talking about 5 hikes, with the first one being of 50 basis points. Now, I must say that this is more worrying than it is comforting. I think they are achieving the opposite result than expected, because I think what the Federal Reserve intended was to bluff. They thought that they could act seriously and convince the public that they would take inflation under control. But actually, the result that had happened was that the public realized that the transitory narrative had been a lie, that they knew that there was been problem, and they had been bluffing all along. And the fact that they have jumped from 3 interest hikes to 4 interest hikes to 5 interest hikes, and particularly if we think that just a couple of months ago they were thinking only about reducing their bond purchase program. They thought they would not hike interest. They would not raise interest rates until they have stopped their bond purchase programs. And then it became 3 interest hikes, to 4 interest hikes, 5 interest hikes. So it seems to the public and to a lot of the investors that the Federal Reserve is actually panicking. And this, of course, does not convey confidence, and nor should it be, because number one, it tells that it confirms to the investors that the people in charge are not really in charge of the situation, perhaps because they have been asleep at the wheel for too long, that it is almost virtually impossible for them to regain control of the situation. Another way to put it is that the genie is out of the box, and it is easy. How to say? I think it was Milton Friedman who said that it's best not to let it come out of the box, because it is impossible or very difficult to put it back, right? This is the situation now, and also just from a material, without thinking about how the confidence of the Federal Reserve, just look at this situation. The public numbers, the official numbers, is that the United States has an inflation of around 7%. But unofficially, we know that the interest rate is higher because they have changed the ways to calculate inflation they have actually changed it multiple times, and they are continually trying to fudge the numbers, they're excluding certain items, substituting others, and then doing a lot of adjustments. And the final result is that they are understating inflation as it is. So let's just say it is 7% inflation. You would need perhaps 10% interest rate to control that 7% inflation, right? To abate that, to stop it. If the real inflation is higher than 7%, if it's double, then you need to reach maybe 20%, just like in the early 1980s. And I think that is perhaps what is needed to get inflation under control. Herein lies the dilemma, right? If the Federal Reserve raises the interest rate, they will to a level that is enough to stop inflation, to get inflation under control. I'm thinking perhaps at least 10%, perhaps even 20%, right? 20% interest rate. That is going to be very bad for the debt situation in the United States in particular. Let's just talk about the United States. The United States, I heard people say, I haven't really made my own calculations, but people were saying that even if the interest rates are at 5%, the United States will pay half of its income, meaning the taxation, right? The government will pay half of its income for interest. Obviously, that's untenable. That means that the government cannot function. All the program would have to stop. The military would not have fuel. That a lot of the government workers, functionaries will not be paid. That means the system will be collapsing. But imagine that would be 10% interest rate, 20% interest rate. What would that do to the debt situation? Right. I think this is already a very difficult situation, very difficult to get under control, and this perhaps is why the bond market is doing very poorly in the last few weeks. And then let's look at the bubble. Well, with interest rates going high, the cost of capital will be high. And all these companies who have been using low cost of capital or zero cost of capital in some cases with all these loopholes, whatever, rebates, they have even negative cost of capital. They use that to inflate their own bubble. what's going to happen to the bubble when the interest rate is 20%? The bubble would deflate, right? That's a given. But in order for the United States to hold its reserve currency status, for the dollar to hold its reserve status, this is what has to be done. And in fact, for the long-term health of the American economy, this will have to be done. On the other hand, let's say that the Federal Reserve does not really take this to an extreme extent, right? Because they're concerned about the debt situation. They're concerned about the bubble in the U.S. economy, and in fact, in the global economy. If they take care of those situations first, what we are going to see, I think, is going to be continued and increasing inflation, and I think it will prompt a lot of countries to rely less on the U.S. dollars for their trade, and it will ultimately lead to the demise of the dollar as a global reserve currency. And then the United States will experience a reflow of those money that has actually flown out, that they exported, right? So the money will come back home and will further lead to even higher inflation and even more debt. And I think maybe some of the assets will actually continue to go up. And I'm particularly thinking about real estate and things like this. So what exactly are they going to do? Now this leads us to the third part of today's podcast. First of all, I must say that all of what I'm going to say now, what I said before, I'm quite confident is a general, is a more or less accurate reflection of the general situation in the global financial markets, and particularly in the United States. But what I'm going to say in the following is purely my personal take. It is certainly not investment advice, and I'm personally not operating on any of this because I don't have money for any of this sort of investment. But what I think is going to happen is that, number one, there's going to be a cascading burst or cascading deflation of some of the worst bubbles. Right? I'm talking about the NFT bubble. I'm talking about the cryptocurrency bubble, particularly the altcoin bubble. I'm talking about bubble in the high tech, so-called high growth stocks. The Cathie Wood's whatever type of stocks, and we are already seeing, in fact, that the cryptocurrencies, those high-tech stocks, are being sold. But what's interesting here is that the markets, because of this low cost of capital, because of the debt situation, because of the unhealthy, the sickness of the bond market, people are not rotating into fixed income. They're not rotating into cash. They're rotating into some value stocks, in particular energy stocks, I think. So I do see that some of these high dividend paying stocks perhaps are going to perform better than, and especially considering that they have been underperforming the market for many years. and especially the context of this green, whatever, right? This green stuff that's bubbling up everywhere. I personally think that this green talk is mostly a grift. I think that certainly there's the environment is a very serious issue. We must not dismiss it. But a lot of these green-related research, you see, I don't really believe a lot of these doom and gloom forecasts. Why? Because you see, a few years ago, there was a guy who insisted that in a discussion with me that these green stuff are true, because over 90% of the researchers, peer-reviewed research, showed that these gave results in support of these green thinking. That leads me to the question: if there are, in today's academic environment, right, if it is possible for about 10% of the people to give results that do not support this narrative, I think actually support is much weaker than the 90% figure is going to suggest. Because if you are a researcher and you say that I'm going to conduct a research, right, and my hypothesis is that the green thing is not doom and gloom, what's going to happen is that your research proposal will be rejected and you will not get funding for it. And then there are people who say that we want to test a hypothesis in support of this green thinking. And then they say, unfortunately, our outcome, our results do not support our hypothesis. What's going to happen is that usually the journals will say, oh, there's no result. These guys failed to produce a result, so we reject. And the fact that some peer-reviewed articles are actually published disputing the green doom and gloom basically means that there is a good argument that in some situations a lot of the doom and gloom are exaggerated. So that's basically a long-winded way of saying, I think it's a long-winded way, but anyway, of saying that energy perhaps is something that's going to be interesting. And then there is currently we are also seeing that the growth in the housing sector, it's really getting hotter and hotter. I think all this is saying is not that individual homeowners are buying more homes. On the contrary, I think it's really because a lot of the financial institutions are able to still leverage their currently low cost of capital to invest in homes with hope that as the crash comes, they will be able to rent out these homes to people who lose their homes. So this is not really a way of expressing confidence in the housing market. In fact, I think it is them saying, our cost of capital is zero, it's negative, we don't care, we have the money, let's put it into something that will sure generate income, because we're not sure which companies will be able to pay dividends in the coming few years, especially those high-tech, high-growth, quote-unquote high-growth stocks. They're probably not going to, with thousands of times of PE, they're not going to pay dividends They're not going to be income generating. So what's going to be income generating? They're thinking about rental properties. I think that's what's happening. So I don't think housing is going to be good unless the US dollar crashes, ceases to be the reserve currency. I do think that a lot of this inflow of US dollars would push up the price. But I think, again, on a nominal term, not a real term. The real thing that I see, the only thing that's going to be safe are some of these precious metals and energy. Basically things that are tangibles, things that are real. We have been on a binge on the virtual economy, whether it's the internet, the technology, AI. Of course, a lot of these things, they have changed a lot of how we conduct our lives, how we conduct our social intercourse, and how businesses are done. They have left their marks. But as income generating options, they have not realized their promise to a large extent. Instead, what these technologies have done is actually made a lot of businesses so efficient that the margins become thinner and thinner, and they do not generate good income. So I think this actually is going to be an interesting question that we are going to really seek to tackle in the coming decades. How can we address the contradiction between a high-tech society and a low-margin society, a low-margin business reality? With regards to the interest rate, I always say that I do not think that the Federal Reserve will be able to raise the interest rates enough to control the inflation. Simply because the debt is too high, the bubble is too big. So what they're going to experience is a gradual. I think they are going to raise interest rate a little bit, but they will try to keep the bubble somewhat stable. They want to keep it the pain longer. So it's going to be some sort of so-called stagflation until at some point US dollar is dropped as the global reserve currency, upon which time there will be some mayhem in the global economy, in the financial markets. But that will be quick, and after which we can reset. And I think that is the real great reset of the 21st century. Thanks for listening to today's podcast. I hope that this is somewhat interesting. I hope that you will agree with at least some of the points that I have made in it. And if you like it, of course, give it a thumbs up and subscribe if you like to. Share it if you like to. Thanks and have a great day.